Okay, many thanks. Many thanks for giving us the opportunity to present this paper called Taxation and Dividend Policy, the Muting Effect of Diverse Ownership Structure. This is joint work with Roni, Michaely, and Annette Alstadsaeter, who is from the University of Oslo. So what is it that we're trying to study here? When we look at theory on taxation and dividend policy, what we find actually, yeah, taxes apparently matter. I mean, this is what we would intuitively would expect to say, when we tax payout of a firm, then this should actually matter for firm decisions. When we look at policymakers, they apparently think in the same way. They would say that dividend taxes should have an influence on consumption of investors, investment policy, payout policy of firms. But when we look at some tax changes, so the 2003 tax cut was motivated in the same way. When we look at changes in the European Union, for example, Finland, Germany, and Sweden changed their tax code. There are many changes to dividend taxation, and all of them are kind of motivated in the same way. And I'm taking here the arguments of the 2003 tax cut. I know you're familiar with them, but if we look at the quotes, it says that the double taxation of corporate income may discourage the payment of dividends, and this even though dividends provide a number of important benefits to investors. So the big question now is, when we have theory and when we have policymakers thinking that, yeah, dividend taxation matters, it is important, what about empirical evidence? And when we look at empirical evidence, even though there are many studies out there that do a very careful job in trying to control for omitted variables, for example, by using natural experiments like the tax cut of 2003, the changes in 1986, or in the UK. But when you look at the results, the effects are not really strong. There are many papers. Some even show an insignificant effect. Others show very small elasticities. And I put up some quotes here. There's a recent paper by Danny Yagan on the 2003 tax cut and investments. And what he says, the 2003 dividend tax cut had no detectable near-term impact on real outcomes. And if I take Roni's paper with his co-authors, when they surveyed managers, well, it is even more extreme. So what managers said, it's clear that investor-level taxes were not a dominant factor. And when they specifically asked the managers about the 2003 tax cut in their 2008 National Tax Journal paper, managers said, well, we conclude that the 2003 dividend tax reduction had only a second-order impact of corporate payout policy. Roni told me that he actually wanted to write down third-order or even no important impact at all. So this is a puzzling result. We have theory on the one hand who says dividend taxation should matter, and then we have empirical results. Managers apparently do not really care much about dividend taxation. And the question is why? And the question is also, when does taxation matter? This is an important question not only for us, but also for practice and tax policy. Because ultimately, tax policy, or let's say the 2003 tax cut, wanted to increase investments, wanted to increase dividend payout. Other reforms in Europe wanted to do the same thing. So how do we address this question? How do we address the question when and why dividend taxation matter for payout? So we do three things, or we have three things in our experiment. The first thing, we have Swedish data. The nice thing about data from Scandinavia is typically you have a lot of data. What we have here is we have data on all Swedish firms, closely held firms, and their owners. The second thing, in the mid-term of our sample period, we have a large dividend tax cut. And the nice thing is that our identification can then use a triple difference approach. So what we do is we take this reform, we take this nice data, and try to show when and why dividend taxation matters. And in 2 bullet points, what is the result? Well, we show that absent of any conflicts between managers and owners, and when the firm is owned by only one owner or 2 owners, we find a very strong impact of dividend taxation, as we would expect from theory. However, when we increase the number of owners, the dividend tax effect disappears very quickly. And when we have 5 owners in a firm, we find that the individual owner cannot shape the payout policy according to his own tax preferences, or in another sense, the tax effect is insignificant. So you may ask, why? Why do we find that the dividend tax elasticity is a declining function of ownership? This is kind of the main result. Well, we show empirically, this is what we will do later, 3 things are at play here. The first is coordination across owners. Imagine we have 5 owners in a firm, then it's not so easy to coordinate wages and dividends between all these owners to really optimize this from a tax perspective. If I'm only one owner, well, I can easily do this. I simply look at my tax situation and I pay myself a wage or I pay out a dividend in the way I like it. If we're 5 people, it's not so easy. The second thing is a tax clientele effect. Let's say Roni, Annette, and I have the firm together, but if I, for example, have a lower tax rate than the other 2, I may have different preferences. And when these preferences are different across owners, then this may reduce, or this reduces the tax sensitivity. Then the third thing we find is that conflict of interest. So we find that when a firm has a manager, then the tax effect is also reduced. And these 3 things are at play, and these 3 things explain why we don't find such a large effect. However, when we go to a setting where there are no frictions, there's a very large effect. So let me briefly tell you something about the data that we do. So this is the kind of the key result. In a nutshell, let me briefly tell you something about the data that we have here. Our sample covers all unlisted closely held corporations in Sweden. So the nice thing about these closely held corporations are that we have firms with only one owner, so basically there is no separation of ownership and control. One owner can decide whatever he wants to do with respect to payout policy. And then we have firms with more dispersed ownership, 4 owners, 5 owners, where things get a bit more complicated. The second nice thing about administrative tax data is that every firm is required to file a tax return. And every owner is required to file a tax return. So we have all this information about the tax position of the firm and the owners. This solves a problem of other studies on private firms where we typically do not have any data. So in the US, it's very hard to get our hands on data on private firms. Even in Europe, where there is some data on private firms, typically smaller firms, medium-sized firms don't really have to file balance sheets, so we don't have this information. There's, however, one limitation to our study. We do not have listed firms in our sample. We don't have this information, therefore we can only focus on closely held corporations. I'll show you in a second what these firms are. However, these firms that we have in our sample are important. So when not only looking at other countries, but in Sweden, the firms that we have in our sample contribute about 50% of the total corporate income. So the 50% of the Swedish corporate tax revenue is realized by our firms. The data that we have, tax balance sheets, profit loss statement of these firms, and the nice thing, we have basically the ownership structure of each and every single firm we have in our sample. So we know the exact number of owner, we know the ownership share, and for each owner we have the individual tax return. So going again to the firm that Roni, Annette, and I own, we would have the tax return of Roni, my tax return, and Annette's tax return. And all of this as a panel, which allows us really to see exactly the tax situation of the owner. So we know the exact tax rate, and we know the exact ownership structure of all our firms. Altogether, about 240,000 firms, 300,000 owners that we have in our sample. What is a closely held corporation? I'm pretty sure that not everyone is familiar with the Swedish system, so the next 3 slides kind of give you a very brief introduction to what is a closely held corporation and how these are taxed. A closely held corporation is actually very simple. 4 or fewer individuals own at least 50% of voting rights. When you have family members in a firm, there can be more than 4 owners. So family members count as 1 in this calculation. And you have to be active in the firm. What is active? Well, the Swedish tax law is pretty lax there. You're active in a firm if you participate in the earnings generation or profit generation. You can do that by simply working 10 or 20 hours per year for that firm. So it's very simple that you are, or it's very quickly that you are active. And just these statistics down there just try to show you that most of these firms that we have in our sample are fully owned by active owners. So we really get, for the vast majority of firms, we really get the ownership structure of these firms. The second thing I would like to tell you is are the tax incentives. So I'm pretty sure that you're not familiar with the Swedish tax system. The first thing that you can see already from the rates, typically tax rates are pretty high in Sweden. So let me briefly tell you something about the incentives and then how the incentives have changed around the reform. We compare 2 individuals. Basically, one is a low-income taxpayer, and this taxpayer can receive wages. These wages are then taxed at a marginal rate of 31%. Alternatively, he can pay himself a dividend. So if you're an owner-manager, you can pay yourself a dividend, and then you pay corporate tax and dividend tax. Combined, this gives you a tax rate of roughly 50%. This 50% you can't pay out as long as you are within the so-called dividend allowance. The dividend allowance is a function of equity and wages to all your employees. It's a bit of a complicated thing, but you can estimate that this is per owner something like, what is it, $15,000 US, $20,000 US for a firm. This is what you can pay out as a dividend up to a rate of 50%. If you're above that, you pay about 67%. Almost no individual in our sample has to pay the 67%. Then the second part comprises high income tax owners. They pay a tax rate of roughly 51% or higher on wages. This higher means a tax rate of up to 68%, so pretty high. When you have a tax rate of 68% on your wages, you have an incentive to pay yourself a dividend, which is, of course, which has a lower tax rate. So pretty high tax rates. How did the tax shock that we used, the reform now changed these incentives? Well, the nice thing for us, for low-income taxpayers, nothing changed. What you see here, the tax rate on dividend has reduced, but still, they prefer wages over dividends. So low-income taxpayers still have a preference for wages. They don't want to have dividends. However, high-income tax owners now benefit from the tax rate reduction. So the effective tax rate reduction, including corporate taxes, is about 7 percentage points. And now, by shifting wage income to dividend income, or declaring wage income to dividend income as dividend income, will increase your net of tax income. Or put differently, high income tax owners have an incentive to pay more dividends. And the second part of this dividend allowance, the amount of dividends that can be paid out, almost doubled. Or in short, high income taxpayers have an incentive to receive more dividends, whereas low income taxpayers have the incentives for these people didn't change. They still want wages. So what we have here, we have a nice treatment and a nice control group. So how do we identify now the effect? The first thing, of course, is a comparison before to after. We simply compare dividend payout before to after the reform. The second difference, as I just mentioned, is whether you are subject to a high tax or not. And then the third difference that matters for us is whether this effect is a function of ownership, whether firms with one owner respond differently than firms with 5 owners. Of course, you're now immediately saying, well, these firms are different. For example, different in terms of size. So is this what we capture here? Is this a size effect? I can already tell you later on in the robustness test, we do a matching where we match on size, number of employees, and cash. Results are exactly the same. So apparently size does not drive this result. And now the next 3 slides basically show you the evidence in a graphical way, our main result. So what is it what we see here? We compare high tax, the difference in dividend payout between high tax and low tax individuals over time. So before the reform, we see that this difference was about 5.8 percentage points. And then when we decrease dividend taxes for everyone, but this dividend tax cut is only relevant for high income taxpayers, we see that the percentage of dividend payout has increased. So, and this is a large increase. This is now an unconditional estimate, so we don't want to really stress this because there are no controls in here, there are no fixed effects in here. This is simply sample average. And when we now do exactly the same graph for individuals where the firm has 5 owners, the response is different. The response is muted. The effect is still there, but it's about half of it. So just because the firm has 5 owners, the increase is about half. And the third, what we now do is we take the last graph and this graph and simply plot the difference between those two. Or in other words, what we now plot is the triple difference. And what is the interpretation of this graph? This triple difference that we find here, the significant triple difference, tells us that the dividend tax elasticity is a declining function of ownership. The more owners we have in a firm, the lower is the response to the reform of highly taxed owners. Of course, there are a lot of concerns about these graphs because it's simply plotting what we observe over time. It's simply sample averages. So what we now do, we take a step further and run a triple diff regression where we take these 3 ingredients, so the post-dummy, the interaction between high tax and post, and then we interact this difference and difference coefficient with each number of owners bin. So 1 owner, 2 owner, 3, 4, and 5. We run this regression at the owner level. So we really look at how much does the owner receive. Later we do this also at the firm level. Results are the same. And the dependent variable we are interested in is the amount of cash, the amount of total compensation the owner receives in the form of dividends. Also here, we run some robustness tests whether the choice of dependent variable kind of explains our result, and we find that, that this is robust also to other settings. So this is then the regression that we run, and the most important coefficients for us are the alpha 1 to alpha 5 coefficients. What do they tell us? Well, alpha 1 is basically the response to the reform of individuals that have high taxes in firms with 1 owner. And then alpha 5 would be the response to the reform in firms with 5 owners. And what we would expect is a decrease in this alpha 1 to alpha 5 coefficients. So by testing whether these coefficients are significantly different from each other, we obtain our triple difference. What we also do, we include firm controls, we include owner characteristics, owner fixed effects, year fixed effects, and what we also do, we allow all control variables to vary before and after the reform. So, for example, size can have a different effect before and after the reform. What do we find? Well, we find that indeed this reform has a significant effect. Let me briefly explain you what this coefficient estimate means. It means that from before to after the reform, owners in firms with only wholly owned firms increase the dividend compensation by 40%. And I would say that this is a large effect. So increasing dividend payout or dividend compensation by 40% from before to after the reform is a large effect. When we now go to firms with 3 owners, we see that this response is decreased by 42%. So again, take the firm with Roni, Annette, and me, then my personal tax preference would not shape the payout policy of the firm as much as it does when I'm having the firm on my own. And this difference is 40%. That's quite a lot. And what we see, as soon as the firm has 4 or 5 owners, this effect is insignificant. What you see back here is that the coefficients are significantly different from each other, or significantly different from the coefficient for 1 owners. So we really see this decline, and this decline is also significantly different from each other. The second thing we do is we subject this to an extensive set of robustness tests. So the first is, I already mentioned this, we estimate the same thing at the firm level. So we measure dividend payout, dividend divided by assets at the firm level, and look at the increase in dividend payout from before to after the reform, and then simply plot the coefficient with confidence bounds, and see again that there is a decline in the response as a function of ownership. The second robustness test I already mentioned, we do a matching diff and diff analysis. So we first match on size, number of employees, and cash, and then rerun the whole analysis. Results are again the same. The third thing we do, we use alternative dependent variables. So we use an indicator for being a dividend payer, or we use dividends normalized with total income of the owner. Again, same result. The third thing we do, we control for passive firms. So there may be firms that you simply use as a holding company, or that is a small company on the side. Typically, these companies are owned by only one individual. And then, if this is only, for example, set up for tax-saving purposes, then it is not surprising that these firms, that you optimize your wage and dividend mix in these firms. So we take out all these firms. We take out also all firms where there is no payout over the whole sample period. Results, again, are robust to this. Then we look at only large firms. So we constrain the sample to firms that are in the top decile of size or number of employees. Again, same result. Almost the last thing we do is a placebo test. What we do is we only have a sample of closely allied corporations. But what about other corporations in Sweden? It could be that there's a macroeconomic trend that may explain all the results that we have here. So what we do is we compare the combined payout of our firms to public firms. At that time, this dividend tax cut was not for public firms. So public firms were still taxed at 30% dividend tax. This tax cut was only for small firms, only for closely held corporations. And when we compare total payout of public firms to total payout of our closely held corporations, we see that, yeah, it's almost a parallel trend prior to the reform, and then closely held corporations increase payout, whereas public firms are still on their normal growth path in line with the normal growth of the economy in Sweden. And this diff and diff is also significant. The last thing we do is an external validity test. We simply run a cross-sectional regression where we look at correlations. Again, here the same result. As soon as owners, the number of owners increases from 1 to 4, the overall effect is insignificant. Same result here. Then the question is why? Why does this effect happen? First, I already mentioned this, is coordination across owners. And the coordination can affect the substitution of dividends with other forms of payout. And in our case, it can be wages. I mean, you can basically give your shareholders a wage. And not everyone, I mean, of course, wages serve as a compensation for labor, but also it can be another form of payout. So the idea is here we test whether wages are tax sensitive and whether this tax sensitivity is a declining function of ownership. And here's a nice thing that we can do. In Sweden, as I said, we have a tax rate of 31%, and then there's a large jump by 20 percentage points to 51%. And this large jump is very interesting to us because above this kink in the marginal tax rate, the dividend tax is below the tax on wage. So the nice thing is that the margin, on the margin, owners prefer dividends. And then we should see bunching at exactly this kink point. And this is what we see. We observe bunching at this kink point, but we split this graph now into firms with 1 owner and firms with 5 owners. And what we see is that for firms with 1 owner, this is the black line with the cross here, we observe 300% more owners than we would observe without this kink. So apparently, yes, owners are tax sensitive. And when we do the same analysis for firms with 5 owners, they're still tax sensitive. Yes, there's still an excess mass, there's still statistically significant, but the response is much smaller. And this difference is also statistically significant. Then the second thing that we do, we rerun the same triple diff estimation. We find the same effect, a declining coefficient, a declining effect. And when we plot this, it looks like this. This gray ones, the gray line here, this is the change in the dividend compensation ratio. This is what we had in the first table. And this is the change in the wage compensation. And you can see there is a 1-to-1 substitution of dividends and wages. So overall, these owners didn't increase their payout. They simply changed the composition of payout. And they did this to save taxes. And this tax saving was about 1% of total gross income. And what happens if when we go to owners, to firms with 5 owners, there's no substitution. There's no effect. So basically, these owners forgo about an after-tax increase on income of about 1%. Then I already mentioned the second reason. Preferences across owners can be, they can be different. And what we do, for the sake of time, I keep it short. We run a regression at the firm level where we say we expect that firms where, on average, individuals have a high tax rate on wages, so they have a preference for dividends, they will respond to the reform. However, when there is a high standard deviation in this tax rate across owners, so there's heterogeneity in the tax preferences, then this response should be smaller. So this is the alpha 7 would be a triple diff coefficient here. And we exactly find this. Yes, firms respond according to the tax preferences of their owners, but this response is reduced if there's heterogeneity. Now the question is heterogeneity, is everything heterogeneity, or is it also coordination? What we then do is we say that we keep every firm preferences constant. So we say that all owners in this firm prefer dividends. And then we estimate the reform response. And still, it is a decline in the response, meaning that it's not only heterogeneity, it's also coordination. The last thing that we do, and I already mentioned this, conflict of interest between managers and owners. And we run again the same triple diff model. Now we change the triple diff into a variable that we call separated, meaning that this firm has a manager, an external manager. And then we see how this external manager reduces the reform response. And again, we find that on average, firms increase dividends when their owners have preference for dividends, but this response is weaker when there is a manager in the firm. So let me briefly wrap up. I think I have 1 or 2 minutes left. What we find is that dividend taxation has a first-order effect. However, this effect is muted when you have dispersed ownership. There are 3 reasons: coordination problems, separation, heterogeneity. Now, of course, you can ask the question, what can we learn from Swedish data? What can we learn from Swedish firms? And we say that these mechanisms that we find here, coordination, tax heterogeneity, agency problems, are also things that matter for public firms. So of course the next step, the next natural step is now to take these mechanisms and test these for public firms. Because, for example, public firms of course have many owners, and then it's very likely that there is tax heterogeneity. It also has policy implications, because when you kind of want to have an impact on payout policy of firms, then you need to set it for firms where the effect is strongest. So when you have a tax cut for only very closely held corporations, or when you have a tax cut where there's a high propensity to substitute dividends with other forms of payout, may it be wages or capital gains, and when tax preferences across owners are similar. And interestingly, Sweden in 2006 apparently, or without knowing because they weren't aware of these results, implemented exactly such a reform. They did not change the dividend tax for public firms. When it came to widely held corporations that have dispersed ownership, hundreds of owners, they had a tax cut of 5%. And for the firms that we have here in our sample, they had a 10% tax cut before including corporate tax. So they had a higher tax cut for firms with more close ownership. So again, exactly what we find here, and apparently Sweden implemented exactly such a reform. You give a tax reduction for firms with close ownership. When you have firms with dispersed ownership, you don't give them a tax reduction. This is what Sweden implemented, and this is everything I have to say. Thank you very much.